Everyone knows Warren Buffett to be the most successful investor in history and one of the richest men in the world. With his net worth in the hundreds of billions, it's quite easy to forget that he wasn't always rich. When he was starting out in his investing career, he surely didn't have the billions he has today. He didn't even have the millions. His first investment ever was worth $114.75, and yet he's worth more than $100 billion today. So how did he do it? In this video, we'll be talking about how you can start investing with smaller amounts of capital and still make it big. Before we get into how to make it big with smaller amounts of capital, if you like our cutting-edge investment content curated by professionals with decades of investing and entrepreneurial experience, consider subscribing to our channel and joining on our alerts so you never miss our new content. Let's start with this. Have a small amount of money in your investment portfolio can give you a huge advantage over Buffett in terms of generating large returns. This is because you're not a billionaire like him. Believe it or not, but it's true. During a Q&A session, even Warren Buffett himself admitted to this fact. He mentioned how he sees many wonderful stock ideas but cannot invest in them because they are too small for the requirements of Berkshire Hathaway. But an individual investor or someone with smaller amounts of capital can. In fact, there are many more investment opportunities for investors with smaller amounts of capital than there are for larger institutional investors. Smaller investors can consider investing in companies that are less followed. And the best thing about these companies is that there are more chances for the market pricing them inefficiently. In fact, this is where your greatest opportunities may lie. When you have some contextual experience with an investment you're considering and have a feeling that it may be inefficiently priced. Another advantage of being an investor with smaller amounts of capital for investment is that you don't have to make large investments to get substantial returns. Take Warren Buffett's company Berkshire Hathaway, for example. It has a current market cap of $680 billion, and while that is obviously a ton of money, what it means is that to have a meaningful impact on the company's results, any of the investments Berkshire would have should represent 10% of its entire value. That means that they target a single investment to be worth somewhere between $65 billion and $70 billion to hit the 10% threshold. Companies like General Electric, Airbnb, FedEx, Ford, and Marriott are all currently valued at around $70 billion. So to get a reasonable return, Berkshire would have to buy one of these huge companies in an elephant-sized acquisition. As Berkshire grows in market capitalization or dollar size, Buffett's investable universe keeps shrinking. The more Berkshire is worth, the fewer potentially investable companies it has. But an individual investor, on the other hand, doesn't need to invest 10% of their net worth into investment for it to have a meaningful impact on their entire portfolio. This is because smaller investors can find and choose smaller companies which can achieve much higher returns from the large companies Berkshire is required to invest in. Going further, smaller companies aren't on everyone's radar as much, which is a huge advantage because generally, as the size of the company increases, more investors and institutional investors follow it closely. And when many investors closely follow a particular stock, the stock is less likely to be undervalued. For instance, Apple is currently valued at $2.6 trillion. There are thousands of smart investors and institutional investors closely following it, and so it is unlikely to be undervalued. However, smaller companies are more likely to be undervalued because they get less attention from investors, so there's a greater chance they'll be inefficiently priced and be undervalued. So, as an investor with less capital, when you find stocks which are inefficiently priced and undervalued, you can actually invest in them and put yourself in a position to realize much larger returns than Berkshire. So what should you do as an investor with small amounts of capital? Take the chance Warren Buffett does not have available to him. Start investing in opportunities that are too small for large institutional investors. Don't waste your time trying to compete against the big institutional players. Instead, focus on small investments that billion-dollar investors and investment funds don't care about and can't invest in. Look for companies where you have some contextual experience so you can identify if they're being priced inefficiently and are undervalued. A lot of institutional investors tend to focus on American-based stocks, but America is not where all the opportunity is. There are plenty of great companies in various industries and countries throughout the world that are potentially undervalued compared to American businesses. The essence of this advantage is of small companies and their ability to achieve higher returns than large or higher market companies is especially highlighted by Peter Lynch, the man who coined the term 10 baggers. 10 baggers are stocks that go on to increase by a factor of 10 from the time of investment. 10 baggers are nearly every investor's dream, and Lynch has talked about them, how much easier it is for a small company to grow by a factor of 10 compared to a large company. Another example of inefficient market pricing is in real estate. Consider a city or an area where residential properties in poor condition can be purchased and their total cost, including renovation, are lower than the value of a renovated property. This is an example of an inefficient market. By focusing on these types of opportunities and aligning them with your own contextual experience, you as a small investor can maximize your potential returns. There you have it, some of our expert advice on investing with smaller amounts of capital. Thank you for watching. If you like our cutting-edge investment content curated by professionals with decades of entrepreneurial and investing experience, remember to like this video, subscribe to our channel, and join in on our alerts so you never miss our new content. Oh, and check out this other popular video on this screen.